Same comment there. Silver, it's moving out of COMEX, either going into private hands, a little bit into London to offset the amounts that were being taken out there. And of course, we saw that on the ETFs chart. A lot of that's happening. And then we think about it.
Welcome to Gold Silver Pros. Searching for the best precious metals deal? Shop with our trusted partner, 𝘲𝑆ilver. Access special deals on silver, gold, and platinum through our website or call 307-264-9441.
Hey everybody, this is Rob Keynes with GoldSilverPros.com. This is your weekly market wrap-up recorded February 17th, 2023. We had a lot of economic news this week. I'll just dive right into that. A lot of attention was paid to the CPI. We had a slight uptick in CPI, or sorry, slight decrease in CPIs, and went from what did we go down from 6.5 to 6.4%. 6.2% was the expectation. So it's maybe just a tad more persistent than the market anticipated, but not enough, I don't think, to make a big deal. It does appear that we're still in that deflationary cycle, though. We had over a 9% print a few months ago. Now we're down to 6%. And I think we're in that first stage of deflation before we get into the bigger stage of inflation, as we've seen in previous markets. The NFIB Small Business Index is at 90.3. That is up from last month slightly, about a half a point. I've been paying attention to what the different Fed participants are saying in their testimony this week. We have here Fed's Barkin, Richmond Federal Reserve President Tom Barkin suggested Tuesday that progress on inflation may be slower than everybody like to see. He says people hate inflation because it seems unfair, according to a MarketWatch article. During a Bloomberg television interview, asked about the latest consumer inflation data released an hour before his interview, Barkin said the overall data was about as expected. Inflation is normalizing, but it's coming down slowly. Moving over to Fed Logan, the Federal Reserve has to manage the risks of tightening monetary policy, said Federal Reserve President Lori Logan on Tuesday, also according to MarketWatch. The most important of these two risks is that the Fed does too little and the economy remains overheated, and the central bank fails to keep inflation in check, Logan said in a speech at Prairie View A&M University. Logan said that could trigger a self-fulfilling spiral of unanchored inflation expectations that would be very costly to stop. We also have the Philadelphia Fed President Patrick Harker on Tuesday saying that they keep raising interest rates at a gradual quarter percentage point pace until they get above 5%. He said during a talk at LaSalle University, Harker said it's going to be above 5%. How much it's going to depend. In his talk, Harker said that the January Consumer Price Index report was good, with continued moderation in inflation, but the pace of improvement is not quick, he added. Food inflation is still really high, Harker said, and the sector continues to be impacted by supply chain woes. I would agree with all that. The New York Fed's Williams says the fight against inflation has a way to go, according to MarketWatch as well. New York Federal Reserve President John Williams on Tuesday said the fight against inflation could be complicated by a rebound in global growth that increases demand for goods while supply chain bottlenecks persist. So the Fed is not showing any signs of pivoting. According to bankrate.com, the federal funds rate is at 4.75. They're almost to the 5%. I'm not sure if they're going to slow down to 5% given their language. And we'll have to see what continues to happen in the economy. Top headline from CNBC as we're recording this is in early Friday trading, the Dow has jumped 100 points, but still heads for a losing week as investors fret about high rates. So the rates are definitely affecting it. The Dow Jones is up about 0.28%. The S&P, NASDAQ are both trading down less than 1%, and the Russell 2K is up about 0.25%. So it's mixed in the markets, nothing definitive. Going over to the bond market, summarizing what we see there, still yield curve inversion between the 10-year and the 2-year. The U.S. 10-year is at 3.821%. The 2-year is commanding a much higher rate, about 0.8% higher at 4.619. Until that changes, the bond market is screaming recession, recession, recession. And that is also a very good indicator. Cryptocurrencies are up, and they have been up for a while. Bitcoin's trading at 24,976, up almost 400 points on the day. If you look at Ethereum, it's up 28 points to 1718. Both of those at about 1.6 to 1.7% increase. Overall, the crypto complex is doing pretty well today. Big news story of the day. I usually do a couple of these to kind of zero in on what's going on, kind of give us a telescope of what's going on into the economy. Headline from CNBC, Amazon tells employees to be in the office at least 3 days a week. It says Amazon will require corporate staffers to be in the office a majority of the time, or at least 3 days a week. Previously, Amazon left it up to individual managers. CEO Andy Jassy wrote in a memo on Friday that it's instructing corporate staffers to spend at least 3 days a week in the office, according to the CNBC story. It marks a shift from Amazon's previous policy where it left it up to individual managers to decide how often their employees would be required to work from the office. Jassy said he and the S team, a tight-knit group of senior executives from almost all areas of Amazon's business, decided at a meeting earlier this week that employees should be in the office the majority of the time. They made the decision after determining it would benefit the company's culture and workers' ability to learn from and collaborate with one another. So Amazon apparently is trending away from where companies were going and having people disperse and saving on their real estate and office costs and having people work from home. And in that article, Amazon is citing the fact that it needs closer collaboration. I also suspect, from having gone through corporate restructurings many a time in corporate America, surviving all but one, the only time I was ever laid off years and years ago, I've learned that when companies request you come into the office and they're talking about productivity, what they're going to do is an assessment. It would not surprise me at all is that they bring people in the office, see who works well together, see who's really doing what, have their managers watch them more closely, and then decide if they need further layoffs and decide who needs to be promoted. So that kind of goes both ways. It would not surprise me at all if that's what's happening at all. And so if you're at Amazon right now, you want to get in touch with your supervisor and see if your job is safe. Just a little pro tip for you guys there. Not to say guaranteed that Amazon's going to lay up, but I think certainly they're doing assessment of their workforce would be fair to say. We're going to present on some key data points I got from a couple of articles. Here's the Bay Area median price. Bay Area homes have fallen 35% since the end, or about middle to end of 2022. So it's marked the end of the bull in the real estate market, and prices are as low as they were in about mid 2019 and also previously seen at the beginning of 2018. There's a little bit of a spike there. Overall, real estate coming down a lot in the Bay Area, which we expect. When real estate comes down faster in the more expensive areas like the Bay Areas, the coastal areas, those types of areas, higher end homes, you can expect that the entire real estate market's been affected. We've seen this in the middle income home. Now we've seen it in expensive areas of the economy. Real estate's not in a recovery and not going to anytime soon. The Bloomberg Commodities Index has turned down. It's turned down since about the middle of this year. Again, deflationary forces I've mentioned a bunch of times. Job loss, slowing GDP 2 quarters out of 4 last year. Slowing earnings, now lowering inflation rates to where the Fed is almost up to the official inflation rate with their interest rate projections. So I think if the Fed's going to pivot, the Fed's going to try to get to wherever the CPI is at least before they pivot and change policy. I think they'll raise quarter point till at least they get over 5 and maybe try to match inflation at 6. Now, I don't think this deflationary trend that we're seeing in the economy that you can see with the commodities index is going to last forever. I think we'll have bouts of inflation deflation. But that's just kind of the narrative of what's going on now. Real quickly, going into the gold market at CME Group, 1852.60 according to CME Group. Of course, gold is trading 1843.12 according to gold price and 2179 silver. So overall, we're looking about the mid 1800s on gold today. Relatively light volume. Of course, we first reported the issue, the cybersecurity incident, on our channel and on our weekly market wrap up last week. I think that is still ongoing. We'll show you what the CFTC has in the COT report here in a moment. But it appears as though not all the data is available and trading has been slowed a little bit now. There is the tendency for the second half of the month for trade to slow a little bit, especially on a weaker month in terms of deliveries in February, and then may also slow some of the derivative trading. But you'll still tend to see a lot of activity because people are rolling to a new month. So April was the dominant futures contract month for gold. Now it's rolling over into June. You can see that slowly happening. And then some people taking an August position here as well on like a third level. And then people already in the December contract as well. So people are already taking year-end positions and then in the middle of the year positions around the summertime for where they think the price is going. Now, when people do that, gold and silver prices do tend to fade in the summer. So as people move their futures positions later in the summer, you'll expect to see the price come down. That is normal because in the summer months, they're betting on lower prices. So they're going to take more short positions. So at this time of year, as people rotate from April in gold, March and silver as the dominant contracts, and they go into these summer contracts, prices will tend to fall a little bit because the futures positions are expecting a little bit more pessimism because gold and silver prices tend to fall during the summer every year. It's not the busiest time for that market. Look, that's Thursday's data. Wednesday's data seems to say the same thing. You're adding contracts in June and August. You're subtracting contracts out of the dominant month in April. And again, you see exchange for physical is still high. People are still looking for exposure to the gold market in London. And that means that they're not finding exactly all that they need on the COMEX, or they're trying to hedge an offsetting physical or paper position in the US with a London position, and maybe a company has an office over there, whatever the case may be. But a lot of times when you see the EFP numbers go higher, it means that people are hunting for different prices and arbitrage and price agreement between the US and the UK markets. Moving over into the settlement section, as of Friday's early trading data, this is not up to date or complete. 154,000 contracts volume closed today already, settling at an average 18.50.20, as you can see on screen, down about $1.60 overall. Not bad. That's an early trading. Thursday closed up about 6.50. You can see here on the April data. This is dominant contract month. Estimated volume 168,509 contracts closed during the day at 1851.80 on average. So you see what's going on with gold. Relatively light trading, relatively light deliveries, but still some indication that people are going on over to London and the EFP market. Of course, we had 2,720 contracts on Thursday go EFP, and then on Wednesday in gold is 1364. So people are hunting around for the best price in gold between the two markets. Silver, about the same thing. Reduced activity here since the cyber attack at the beginning of the month. You see the activity around the reported day of the cyber attack. As soon as the report on the 2nd, it just kind of fallen off. You can see that trend. Although I will also point out some of this trade tends to fall off during the month as well, as people move to different contract months, roll contracts. They've already stood for delivery, but you should still see some spikes along the way. We're seeing just sort of muted trading here. You can see there's histograms that stick out during the middle of the month in January, not as much in February. So some of this could be attributed to the cybersecurity attack or just general malaise in the market right now towards gold and silver as well will allow for that possibility. As I mentioned earlier, alluded to, silver, the dominant contract month is March, but you can see 5,819 contracts rolled out on Thursday. And then 2,433 of those went to May, 25 went to April, 140 went to July, and then 4 went to March of 2024, 1 to December. So a little bit of rotation out of silver. Hunting for value in the London market, 1,327 EFP contracts closed in silver on the March contract for Thursday. And then for Wednesday, 526 EFPs, not as much. Still some rotation out of this month's contract, most of it into May, which looks like it's become the dominant contract month. In fact, it's only a few contracts behind. So May will start determining here pretty soon, maybe the next week or two, what the silver price is more than will the March contract. And that's how futures work. They just roll over. And that's why you see this rotation in this column. We want to go and look at the actual settlement data. This is where you get the price data. Again, March is dominant contract month. As of Friday so far, as reported by CME Group, 62,469 closed contracts, average price of 271.715, which would round up to 72 at your local dealer. Well, before they add their premium, that's up about 5 cents so far today. If we look back on Thursday, the close data up almost 14 cents to 21,710 on 56,658 contracts. Going back to the CFTC Group, they have issued a news alert on when the COT report may be available. This is not the right one. Let me go back to the news section. It came out yesterday. This is release number 866223, and I'm just going to read it. CFTC announces postponement of commitment of traders report. Staff of the CFTC divisions of clearing and risk, market participants, data, and market oversight today released the following statement to update the public on reporting delays due to the cyber-related incident at Ion Clear Derivatives, a subsidiary of Ion Markets, a third-party service provider of clear derivatives order management or execution, trading, and trade processing. Again, I'm just reading right off the CFTC's website for those of you on the podcast. Now, I have covered this more extensively on my channel at GoldSilver Pros, but we did want to announce it as it is delaying some of the available trade data so that we can't analyze certain parts of the market. At the end of the day, we're going to wait for more updates on the CFTC. Of course, this also affects traders as well if you follow the previous news releases. Here's the quote from the CFTC, the second paragraph. Following the Ion cyber-related incident, reporting firms are continuing to experience some issues submitting timely and accurate data to the CFTC. As a result, the weekly commitment of traders report that normally would have been published on Friday, February 17th will be postponed. Continuing on the CFTC quote, CFTC staff intends to resume publishing the commitment of traders report, or the COT report, as early as Friday, February 24, 2023. So that'd be a week from today when I'm recording this. Staff will begin with the COT report that was originally scheduled to be published on Friday, February 3rd, 2003. That would be the first one from the missing batch, because we do have the July 24th one that is available. And that was my comment going back to the press release. Thereafter, staff intends to sequentially issue the missed COT reports in an expedited manner, subject to reporting firms submitting accurate and complete data. Staff anticipates that pending the timely, accurate, and complete submission of backlog data by reporting firms to the CFTC, these missed COT reports will be published by mid-March. After that COT report publication, will resume its usual weekly schedule. So some of this can be backlogged to mid-March. My question was, who has ownership of that data? Because it appears as though, I mean, the COT reports are there, but if you look at what the CFTC says on their website, under CFTC data. It does say that the CFTC relies on data collected from market participants to conduct all of its mission functions, including oversight, monitoring for liquidity and systemic risk, oversight of market participants, regulatory compliance, and enforcement. At the end of the day, some of that data comes from market participants, and that's why it's being delayed. Enough on that. I just want to make sure to cover it. You guys know we're going to move into the charts on gold and silver. We're here at Gold Charts R Us, the best place to see trending in gold and silver physical, because you kind of get it all in one place, as instead of pulling it from different places. So we're looking at physical here. We're looking at changes to flows into COMEX. We can see it's all negative for the last 4 weeks. That's not a change. Overall, it's slightly positive, however, of about, I would say, about 400,000 to 500,000 ounces into most of the London vaults. Most of these ETFs store in London, not all. Some of this is in the US or other places, but for the most part, it gives you a fairly good idea what's going on in London overall. In gold, a slight uptick, as you can see here, the past couple of months, but not enough to make up for the 2-year trend. This 2-year trend has not been anywhere near broken in physical inventories made available in either COMEX or the London markets overall net for the last 2 years. For silver, same thing for the last 2 years. We've seen it come down. That's the SLV, silver in SLV is this chart right here. A slight uptick lately, a little bit increase in investor or generalist investor demand coming here, which is positive for the gold and silver markets. But overall, it's only a slice of what has come off the market the last 2 years that we showed you on the COMEX and elsewhere. The 4-week change on the COMEX for silver is down about 10 point something million ounces, up 21 million ounces overall. When you compare all the ETFs, whether it be ETFs and COMEX, whether it be London, US based, or anywhere else this metal is stored. So overall, about an increase for the ETFs, 31 million, but a decrease on the exchange. The US exchange is about 11 million. That $32 million, 32 million ounce difference, I'm sorry, between the overall world increase in inventories and the decrease in US clearly points out that both gold and silver are moving from the West either to London or other Eastern destinations. You can see that clearly in the numbers. Of course, as we look at London, not a lot's moving into London. So because it's coming off of COMEX and we see this decreasing trend in London, that means it's probably more moving east. It may be moving through a conduit through EFP, perhaps positioning and potential some physical from the US to London, because according to CME Group, you can hunt for the physical over there. Usually the EFP is you're looking to take a position in London to offset, but if you do an EFP at the same time that you may say, hey, I want to take some metal off of COMEX and put it in London at the same time, that may be why you see this almost flat lining of gold here when a COMEX was rolling off, because some of that metal may be coming through London, but a lot of it we suspect may also going through other markets as well, because the majority of what's rolling off of COMEX is not coming here. So it's either going to private investor hands, or it's going east, or it's going to another market. Silver is basically flatlined as well, not as much coming off. And for the January of the London vaults for silver, so overall it looks to be about the same. Same comment there. Silver, it's moving out of COMEX, either going into private hands, a little bit into London to offset the amounts that were being taken out there. And of course, we saw that on the ETFs chart. A lot of that's happening. And then we think a lot is going into private hands as well. That's going to do it for today, guys, on the week of the market wrap up. Just to sum, we do have some challenges with real estate, high-end real estate prices. We still have some challenges with a lot of what is going on in the economy as well. We're having a lot of deflationary tendencies. Some things are slightly positive, but not enough to offset all the things that are negative. To add in a data point I didn't mention, but I've covered in articles and in social media this week, in terms of corporate earnings for the S&P 500 for fourth quarter, as those start to roll in fourth quarter 2022, we're seeing that about 69% of companies, according to FactSet last week, had slightly positive earnings, some very positive, but overall net slightly positive. But the rest, the other 31%, were dragging the S&P 500 down to negative territory. So the ones that weren't doing well were doing worse as a percentage of negative growth than the 69% that were doing well. So we have a lot of firms either holding steady or slightly doing better, or maybe even medium doing better. But the 31% that's not doing well in the S&P 500 is doing worse than the 69% doing well, to the point that it drags those numbers way down. So if twice as many companies are doing better than the amount of companies doing worse, then those ones worse to drag everybody down have to be doing really sort of bad, if that makes sense. Hopefully I'm painting that picture. So there's a portion of the market which has earnings. The finance sector took it on the chin. Some of the hospitality sector took it on the chin. So certain areas of the economy aren't doing so hot. Education is doing okay. The government's kind of mixed. But the parts that are doing badly in the economy are doing really badly. So is that a contagion, or can that be contained in the second quarter? So as second quarter earnings reports come out, we'll report on that and see, is this a contagion spreading across the economy with corporate earnings, or was it contained for certain reasons to certain sectors of the economy and that trend reverses? We'll follow that. All right, this is going to do it for today. Thank you guys so much. For 𝘽𝙀𝘾 Bullion and GoldSilver Pros, this has been Rob Keynes.
Hey, thanks for watching. We selected these videos just for you. Check them out. And remember, $4.99 a month keeps the lights on and the channel going. So join our GoldSilver Pro supporter membership. We appreciate your support. Keep stacking.